After more than a decade of chain stimulus packages and extremely low rates, with trillions of dollars of monetary stimulus fueling elevated asset valuations and incentivizing an enormous leverage bet on risk, the idea of a controlled explosion or a soft landing is impossible. The first problem of a soft landing is the evidence of the weak economic data. While headline unemployment rate appears robust, both the labor participation and employment rate show a different picture, as they have been stagnant for almost a year. Both the labor force participation rate and the employment population ratio remain each below their February 2020 values, as the April jobs report revealed. Real wages are down, as inflation completely eats away the nominal wage increase. The change in real average hourly earnings combined with a decrease in the average workweek resulted in a decrease in real average weekly earnings over this period. The second problem of believing in a soft landing is underestimating the chain reaction impact of even allegedly small corrections in markets. With global debt at all-time highs and margin debt in the U.S. alone at $773 billion, expectations of a controlled explosion where markets and the indebted sectors will absorb the rate hikes without a significant damage to the economy are simply too optimistic. Margin debt remains more than $170 billion above the 2019 level, which was an all-time high at the time. However, the biggest problem is that the Federal Reserve wants to curb inflation while at the same time the federal government is unwilling to reduce spending. Ultimately, inflation is reduced by cutting the amount of broad money in the economy. And if government spending remains the same, the efforts to reduce inflation will only come from destroying the private sector through higher costs of debt and a collapse in consumption. The Federal Reserve cannot expect a soft landing when the economy did not even take off. It was artificially induced with a chain of newly printed stimulus packages that have made the debt soar and created the perverse incentive to monetize all that the federal government overspends. The idea of a gradual cooling down of the economy will be exposed as a lie by the reality of emerging markets and European banks. The relative strength of the US dollar is already creating enormous financial holes in the assets of a financial system that has built the largest trade in currencies against the dollar in decades. At this moment, it is impossible to calculate the nominal and real losses in pension funds and the negative result of financial institutions in the most aggressively priced assets, from socially responsible investment and technology to infrastructure and private equity. We can see that markets have lost more than $7 trillion in capitalization in the year so far with a very modest move from the Fed. The impact of these losses is not evident yet in financial institutions, but the write-downs are likely to be significant into the second half of 2022, leading to a credit crunch exacerbated by rate hikes. Central banks always underestimate how quickly the core capital of a financial institution can dissolve into inexistence. Even the financial system itself is unable to really understand the complexity of the monetary plumbing from the numerous types of assets. That is why stress tests always fail, and financial institutions all over the world have abandoned the healthy process of provisioning, expecting a lengthy and solid recovery. The Federal Reserve tries to convince the world that rates will remain negative in real terms for a long time. But borrowing costs globally are surging while the US dollar is strengthening, creating an enormous vacuum effect that can create significant negative effects on the real economy, before the Federal Reserve even realizes that the market is weaker than they anticipated, and liquidity is significantly lower than they calculated. There is no easy solution. There is no possible painless normalization path. After a massive monetary binge, there is no soft hangover. The only thing that the Federal Reserve should have learned is that the enormous stimulus plans of 2020 created the worst outcome: stubbornly high core inflation with weakening economic growth. There are only two possibilities, just two: to keep lying about being able to fight inflation by tightening, or reverse course and make citizens poorer while maintaining the so-called bubble of everything. None is good, but they chose an unprecedented response to the pandemic lockdowns and created a decisive and unprecedented global financial risk. They thought money creation was not an issue, and now the accumulated risk is so high it is hard to see how to tackle it. Now it is too late. Powell will have to choose between the risk of a global financial meltdown or prolonged inflation. No matter what, whether it's short and quick or a prolonged event, there will be no soft landing of any kind. To be honest, I'm not sure how anybody could even think there could be a landing. The reason there can be no landing was just outlined a few moments ago, so the only thing that's left is, sadly, a crash and burn scenario.